The number one question I get every single day is this. If XRP is genuinely the bridge asset the institutions have been building toward, why is the price still acting like nothing is happening? Let me pull back the curtain, because what I'm about to walk you through is not being explained to retail investors the way it should be. While most of the crypto crowd was busy doom-scrolling charts and arguing about meme coins on Twitter, the CEO of the Depository Trust and Clearing Corporation, the DTCC, the same entity that quietly cleared $3.7 quadrillion in transactions last year, walked up to a podium and put every single financial institution in the United States on notice. He didn't ask. He didn't suggest. He told them, prepare to connect to Layer 1 blockchains. October is the live launch. July 13th is the soft launch. The countdown has begun, and the world missed the signal. This changes everything.
Make sure to like and subscribe and drop a comment below with your opinion on XRP and watch until the end, because the final minutes reveal why July 13th could change everything. Welcome back. Today we decode the most consequential institutional announcement of this cycle, not with hype, not with moonboy fantasy, but with data, structure, and the cold mathematics of what just happened. Before we go under the surface, nothing here is financial advice. In this briefing, we examine why the DTCC's October deadline is the inflection point the architects have been building toward for a decade. Let's start with the hard truth. 99% of people in this space are staring at the wrong thing. They're watching candles. They're watching influencers scream about alt season. They're watching the noise. Meanwhile, the actual plumbing of the global financial system is being rebuilt underneath their feet. To understand the opportunity in front of you, we must first understand a hidden factor that retail almost never discusses: the difference between a settlement layer and a speculation layer. Bitcoin is a savings token. The vast majority of crypto assets, and we're talking hundreds of thousands of them, are speculation tokens with no institutional use case. They will be totally worthless when the music stops. But there is a third category. A small handful of utility ledgers that institutions can actually route value across. Compliance grade, deterministic, auditable. The kind of infrastructure a custodian holding $80 trillion can legally touch. You see, retail investors buy a token and hope. But financial institutions, they cannot operate on hope. They need rails. They need rails that settle in seconds, cost fractions of a cent, and don't expose them to consensus risk or validator capture. They need rails that regulators have already greenlit. This is why the DTCC's words matter. When Nadine Chakar, head of DTCC Digital Assets, explicitly named collateral mobility as the killer app for institutional blockchain use, and when the DTCC's own cross-chain liquidity framework explicitly references Ripple and the XRP ledger as compatible infrastructure for tokenized assets, that is not marketing. That is the architect telling you which pipes the water is going to flow through. Think about this logically. The DTCC settles $4 quadrillion a year. They do not name a blockchain casually. They do not flirt. They do not experiment in public. When they put something in a framework document, it is because the legal, operational, and technical due diligence is already finished. The signal is clear, but only for those who are actually looking. Let's do the math. The math that the crowd ignores. The DTCC, the NASDAQ, and the New York Stock Exchange are coming on-chain over the next 12 months. BlackRock alone, Larry Fink's machine, is tokenizing roughly $5 trillion of assets globally. BNY Mellon and State Street combined custody somewhere in the neighborhood of $80 trillion in assets that are now tokenization candidates. Franklin Templeton's Benji platform is already minting and settling on the XRP ledger, with RLUSD as the liquidity leg and regulated distribution flowing through Asia. Now stack the addressable market. Cross-border payments alone, $150 trillion annually. Foreign exchange, $7.5 trillion daily. Derivatives, $1.2 quadrillion notional. Nostro Vostro accounts sitting dormant across the global banking system. $27 trillion locked, waiting to be freed. Now, look at the supply side. XRP has a fixed cap of 100 billion tokens. Circulating is roughly 55 to 57 billion. The rest sits in escrow, with releases largely relocked month after month. Exchange reserves are draining to multi-year lows as institutional custodians quietly accumulate. Here's the math. If you want to move $100 million across a corridor and XRP is priced at $3, you need over 33 million tokens to do it without slippage. At $30, that same transfer only requires 3.5 million. At $300, you need 300,000. The higher the price, the more efficient the rail. The more efficient the rail, the more institutions route through it. The more they route through it, the higher the price must go to clear the volume. This isn't a prediction. It's a design requirement. If XRP captures just 1% of the cross-border payments market, a single percent, that's $1.5 trillion of annualized flow chasing a liquid supply that institutional custody is actively shrinking. If you have a problem with these numbers, you don't have a problem with me. You have a problem with arithmetic. This is the logical mathematical outcome. While retail investors are panic selling because the candle is red, the institutional signal has never been louder. Look at what just happened. The DTCC has assembled an industry working group of more than 50 market participants, banks, custodians, broker-dealers, market makers, pension funds, insurance companies, asset managers, and explicitly asked them which Layer 1 networks and wallets they plan to use by October. That question is only asked when the answer has already been decided behind closed doors. Ripple Prime is now a named DTCC Industry Working Group member. Ripple Prime will settle across the XRP ledger through the DTCC tokenization engine. Read that sentence again. The premier clearinghouse in the United States is wiring Ripple's institutional rail into its tokenization stack. David Schwartz himself flagged it as seems important. When the CTO of Ripple says something seems important, it is not subtle. Franklin Templeton, a firm managing approximately $1.5 trillion, has its Benji platform connecting directly to the XRP ledger for on-chain SGBI minting, with DBS exchange handling, RLUSD swaps, and the Monetary Authority of Singapore license sitting behind the distribution. That is not a sandbox. That is regulated, production-grade, cross-jurisdictional tokenized money market infrastructure. The XRP ledger just surpassed BNB in real-world asset tokenization, sitting at roughly $4.1 billion on-chain, with insiders suggesting the true figure is closer to 4.7 or 4.8 billion. It is now closing on Provenance and Ethereum from below. Ask yourself this brutal question. Does a trillion-dollar firm like Franklin Templeton commit production infrastructure to a ledger without absolute legal and operational certainty? Does the DTCC name a partner publicly without years of quiet diligence? Absolutely not. They don't gamble. They position. This isn't retail FOMO. This is calculated positioning by the silent actors who already know what October looks like. Now let's talk about the calendar, because this is where temporal urgency becomes very specific. July 13th, 2026, the DTCC begins the soft launch of tokenized U.S. assets directly from the depository. Not a proof of concept, not a pilot. A soft launch. The infrastructure goes live, and a controlled subset of institutional participants begins to operate on it. October 2026, the full live launch. This is the date the CEO of the DTCC explicitly told the room. If you are not operationally ready by this point, you will be left behind. He used the phrase, financial institutions need to take action right now. Twice. When the DTCC's tokenization service is fully operational and the XRP ledger is sitting in the framework as approved interoperable infrastructure, The regulatory gate that has held the wait-and-see capital on the sidelines vanishes. The risk premium that has suppressed institutional allocation collapses. A senior executive at one of the largest banks in the country reportedly told the room their management team has said the bank needs to go from 0 to 500 miles an hour on crypto. Banks do not go from 0 to 500 miles an hour on anything. When that level of language enters a boardroom, the decision has already been made upstream. The fuse is lit. The countdown is no longer theoretical. We are moving from an era of abundance to an era of scarcity. And most people will not realize it until the door has already closed behind them. Here is what happens between now and October. Custodians like BNY Mellon and State Street begin moving allocations into cold institutional vaults to prepare for tokenized settlement. Once a token enters a multi-signature institutional vault tied to a regulated settlement obligation, it does not come back to market for a 10% profit. It is gone. It becomes part of the plumbing. Exchange reserves are already draining. The float that retail trades against is shrinking in real time, even as the demand side, the actual settlement use case, is about to step on the accelerator. When the final switch is flipped in October, the wait-and-see money becomes all-in money in a single quarter. The retail bid you see on your screen today is not the bid that will exist when sovereign custodians, pension funds, and global asset managers begin routing tokenized collateral across the rail. The institutions have spent years trying to shake you out so they can take your position. Every flush, every fake breakdown, every XRP is dead headline, that is the smokescreen. That is the predator waiting in the shadows while the prey grows tired and walks away. The exit liquidity of the confused is funding the entry of the informed. I know it's tough to watch the chart drift sideways while you're hearing announcements that should, by any rational reading, have already repriced this asset. I know the headlines create fear. I know the comment sections are full of people who gave up 6 months ago and now mock anyone still paying attention. But as an analyst, I am trained to distinguish between noise and signal. The signal is this: the DTCC, named the rail. Franklin Templeton built on the rail. Ripple Prime is settling through the DTCC. RLUSD is the liquidity leg. The Monetary Authority of Singapore is regulating the distribution. BNY and State Street are getting ready. October is the date. The noise is everything else. Being early feels exactly like being wrong, right up until the moment reality catches up. And reality, in this case, has a published deadline. The question isn't whether the price will recover. The question is, who will still be holding when the institutional rail goes live and the float that exists today is no longer available to anyone who didn't already position? Make sure to like and subscribe and drop a comment below with your opinion on XRP, and watch until the end, because the final minutes reveal why July 13th could change everything. Price is a distraction. Value is the reality. One side of this market is staring at candles and waiting to be told what to think. The other side is reading DTCC framework documents, watching Franklin Templeton mint sovereign assets on the XRP ledger, and quietly building a position that they have no intention of releasing for a quick trade. The question is, are you watching the noise, or are you watching the structure? History does not reward comfort. It rewards those who pay attention when the room is quiet. If you made it to the end of this analysis, drop the word plumbing in the comments. I want to see who actually understands what just happened with the DTCC. If you value this kind of deep dive, subscribe and turn on notifications, because between now and October, the signal is only going to get louder. In a market fueled by emotion and noise, we thrive on data and composure. Haste leads to loss. Calm analysis leads to victory. Stay patient. Stay rational. The math doesn't lie, and the system is almost complete.